Welcome to Frankly Speaking, the podcast on responsible business from Frank Bold, the European public interest law firm. I'm Richard Howitt, and after leading debate about responsible issues for many years in the European Parliament, I host our discussions about the latest development in corporate sustainability, sustainable finance, business and human rights. Today you thought the omnibus was over, but revised European Sustainability Reporting Standards ESRS, under which companies report according to Europe's Corporate Sustainability Reporting Directive, are still to be finalised. This month, the European Commission published its draft revised ESRS for public consultation, and in this edition of Frankly Speaking, we assess the proposals with two members of the EFRAG Sustainability Reporting Board who have contributed recommendations for the changes. Welcome back to Frankly Speaking, Head of Frank Bold's Responsible Companies section, Filip Gregor.
Hello, Richard.
And welcome Global Head of Sustainability at Royal Philips, Simon Braaksma.
Welcome, and thanks for the invite, Richard.
You're very welcome, both of you. First, Philip, we'll get into the detail later, but overall, how would you describe the changes brought forward by the Commission, and what's your overall assessment of those changes?
Well, it is a mixed bag, but I would say that on key principles, the Commission has held its ground, and I've heard that lobbying was quite intense. So I'm personally pleased that all those, I would say, carefully calibrated principles that we have discussed in the EFRAG have been confirmed by the Commission, from fair presentation to double materiality to alignment with due diligence regime and so on. So when it comes to the main principles and improvements that we have made to the standards, I think that what Commission has done in its review is just only strengthening that.
And Simon, many companies are complaining of fatigue with all the constant changes at the European level. From a corporate perspective, how important is this latest stage, and how much do companies need to take part in this consultation now?
First of all, the consultation is not called for nothing. Have your say. So if you want to be heard, you should review carefully what has been proposed now by the Commission and react. We as a company will certainly do so, and we'll do so also via our engagement platforms. If you look at what has been done, and I agree largely or completely, in fact, with what Philip just mentioned, the initial, what we call Set 1 ESRSs have been developed in a record at a record pace. We were not able to road test anything, and as a consequence of that, we were not surprised, but overwhelmed, I would say, with what we had to do in year one. And it took us 2 years to prepare for this. We managed, and so did all the other Wave 1 companies. The fact of the matter that we now in year 3 have a simplification for many companies, if you have been doing this for 2 years in a row, the simplifications in year 3 are welcomed, but they don't really help you that much. They will in the longer run, because you need lesser efforts from your auditor. For example, if you've got 40% less disclosure requirements that you're reporting on, for example, or 50% for that matter. Of course, it means in the longer term a little bit less work, but most of the work will still be in the quantitative disclosures, and most of them rightfully do remain. Some of the qualitative have been reduced significantly in number, but those are normally the ones that are a little bit less effort. But if you've got, instead of 800, 400 disclosure requirements, the effort of the auditor, for example, will definitely be less. But I would say for Wave 1 companies, if you have implemented this and done this for 2 years in a row, you're ready for it and you can handle all of this. And the change that you refer to, if I look at my own company, we developed an ESG reporting manual. That one has to be changed again. We have a tooling to support the publication, a content management system. That one needs to be changed again. So what we hope for now is that once we've got this simplified set of standards, that things remain stable for the years to come. And the simplifications are mainly beneficial for Wave 2 companies, I would say.
Okay, and just a reminder that the Commission hopes to finalise the new standards by the end of June. So it's not long that companies will have to both respond to the consultation, but also find out what the final framework looks like. Now I'm going to ask the same
but
question.
one caveat, Richard. What is good to know as well, that although the Commission aims to finish all of this by the end of June, which is good and timely, I would say, companies do have the option to continue reporting over the year 26 in the old way or in the new way. So the simplified standard. So if you say, this is all too late for me, I just roll over or roll forward, which many companies did in year 2 of the CSRD, of course, you can continue to do so. But if you opt for the simplified standards, which we aim for, but we will need to see, then you can do so as well.
A really important explanation. Now, so one question I'm going to put to both of you, because obviously there's a lot of detail here. Give me just one of the changes that you think is most significant and tell us why. Philip first.
I would say fair presentation. I think that's the basis, the ground, for all other questions, all other principles in sustainability reporting. Some argue it was already there. Some argue it wasn't there. I would just say it was there in spirit, and we clarified what this principle means. And it's something that is meant to help companies quite a bit, to make their reporting much more focused and not to, be bogged down in a detailed and sometimes silly discussion with auditors on every single aspect of information. And at the same time, it should be good for transparency and for users, because it should result in reports that fairly represent or faithfully represent companies' impacts, risks, and opportunities. So this was really supported by a lot of preparers and by a lot of users and so on and so forth. But also, there was a major opposition to that. I've got, Richard, maybe for later, also some, criticisms of some of the changes. But for the good things, I would just say is the fair presentation.
And when Patrick de Cambour came on this podcast in January, he made that point very strongly. It was recommended by your board and EFRAG. But the Commission have made a change, haven't they? Now fair presentation applies to the overall report, not to every single data point, which looks a bit like it's being diluted. How do you read that?
I disagree, actually. It was always meant to be a fair presentation on the overall picture, right? So that was really the spirit of the discussions within the EFRAG. And so what the Commission did is that they brought this aspect or this understanding of how to work with fair presentation more to the forefront. But it's not really a change, I must say.
If I may chip in from my own company perspective or the Dutch market perspective, this was never a discussion in the Netherlands and in many other countries. So a number of countries did play this up because of specific reasons. It was a huge fuss, but we thought it was a storm in a teacup, as you say in English, I think. In the Netherlands, nothing will change. Reporting has always been based on fair presentation, and that is also how, in that spirit, we did draft our first, CSRD compliant report in 24, and so did all the Dutch other companies. So that is the perspective from many countries, I must say.
And one different change in the set of recommendations from the Commission, Simon, pick on another one.
I find it difficult to pick on one because I think the overall package has been discussed extensively and with a lot of effort and eye for detail. So I would say that overall it's an improvement, and I wouldn't call out one specific element. The fact that we are clearer on the DMA and how that would be performed. That was we did that already in the simplification proposals that were released earlier, and that gave a lot of relief to companies because also that due to its unclarity maybe or interpretation that was different by different auditors in different countries, different companies in different countries. It created a lot of fuss and also reports that were unreadable, in fact, with in some cases more than 100 IROs that were described at length, sustainability statements of 200 to 300 pages. Nobody's going to read all of this. It was never the intention of the CSRD and the ESRSs, but that element has been clarified. So what I do hope with all the changes that have been now included is that we will end up with more readable, more insightful reports that will drive action, because all of this is all about urgent action that is needed, not about creating the best reports.
If I may jump in, and I think Simon is very right in pointing out that what's really important about what the Commission has done to the EFRAG's technical advice is not so much what they changed, but what they did not change. And I think the simplification of double materiality process is, is a major relief for the second wave in particular. I mean, companies such as Simon's have already gone through that, right? And it's really good that they haven't, broken it. and that's one thing. And the other thing that was very relieved to see that the Commission did not change was this issue of, not splitting the double materiality into completely separate, like financial material report and impact material report, as the ISSB was really pushing for, under the argument that if things are reported in an integrated way, it will somehow obscure the information on material risks and opportunities. And it was a major worry that they would do that would result in reports that would be less useful, and but that's for Simon to say, I suppose, more difficult to put together by companies. So I was very pleased to see that they haven't really succumbed to this pressure.
If I may react on that, I think Philip is raising a good point. Again, a topic that was brought up and blown up, in my opinion, that was not an issue at all, was this specific late lobbying for splitting disclosures on financial versus impact materiality, and people who suggested that, I think, are coming from a specific position, which I respect, but the practical implementation would be very complex reporting, duplications that would be created, or illegible reports. And I did not come across any stakeholder that had issues in, understanding where to find which information. So I'm also really happy that the Commission kept its back straight there. And I think practice will teach whether this is an issue in the years to come or not, but I don't think so.
And Philip, if I can just sort of tease that out. So it was Responsible Investor, the publication, that said that there'd been very last minute lobbying by business, and by German businesses in particular, that this should be used to essentially implement the International Sustainability Standards Board, ISSB standards at the same time. And it seems that the Commission didn't want to do that, didn't want to separate financial and impact materiality, as Simon has just been talking about. Is that a correct reading of the situation? And what's behind that? Why did the Commission take that view?
Yes, it's a correct reading, and that's exactly what Simon and I just exchanged about. I don't know why Commission have held their back straight. I have heard that the lobbying was quite brutal on this one. I suspect it was not really because of the stated objectives, right? I mean, the demand or the request was perhaps fueled by different concerns and different objectives, and I think this is a part of a larger struggle about who gets to say how the standard should look like, who gets to say basically how the sustainability reporting standards will be shaped in Europe and globally. I find it very unhelpful, this kind of animosity, and this kind of a power struggle sometimes between Europe and the ISSB. And I'm being a little bit frank and bold here by basically saying that I did not find those arguments justified, and I would say substantiated. And it's quite possible that that's exactly what the Commission said, that they were simply not convinced about what they were presented. And I think that quite a few people from the business community have reacted to those proposals with concerns that actually wouldn't be helpful, whether for preparers or users.
The main theme of these further changes seems to be further simplification, but when I look at the provisions for climate transition plans, it seems it's more prescriptive. companies having to be clearer about whether they're meeting the 1.5 degrees Paris target or not. And when I look at what companies have to report about energy, they have to break down the different sources of energy that they use. So there are some elements that this looks like not simplification, but a sort of tightening up. Do you think that reading is correct? But also, what do you think is behind that? Either of you, please jump in.
There actually has not been that many changes in the climate change standard, whether by EFRAG or now by the Commission. There's one important change that I'll mention in just in a minute. But what we have done in EFRAG, I'm quite proud of that result, is that we really made it standard more simple to read and understand. So that's the major change, especially on some of the more complex disclosures such as climate risk, resilience, and so on and so forth. So it's much more understandable. The standard is shorter and so on, but the spirit and the key disclosures actually remain quite same or quite similar. I don't think there's a tightening, not at all. It's more like, it stays the same in the, I would say, positive sense of that word. Now the Commission, in their now draft delegated act, which is in the heavier say consultation, did make one single and consequential change to the EFRAG technical advice. And that is that it basically gave companies a free choice to decide how they set their reporting boundary for GHG emissions. So under the original standards, companies had to calculate emissions for everything they control, financially, their subsidiaries, as well as operationally. In case they have the assets they didn't own, but they operated, they had to basically produce both figures. Now, in the spirit of simplification and reducing burden, in the EFRAG we agreed to retain this only for the financial control and make essentially optional operational control reporting or boundary setting optional. Now, the Commission went much further, and they basically said, well, companies can freely choose. It can be financial control, it can be operational control, or it can be equity share. Whatever is currently permitted in the GHG protocol. But the GHG protocol is much more a management standard, not a reporting standard, so it doesn't care so much about comparability of the data. So by removing the financial control reporting boundary, that is accounting for all the emissions of all your subsidiaries, just we're removing, the basis for comparing or comparability of the data disclosed by different companies, and that newly permitted option of calculating, or setting the reporting boundary based on the equity share, that's used by only a few % of companies around the world, is generally not considered, useful. And so this is really abandoning, the idea that the GHG emission accounting should be comparable. And I'm very worried about, this change introduced by the Commission from a user perspective. From companies' perspective, from preparers' perspective, it doesn't really, make a difference. But from users' perspective, comparability of data and potential risk of abuse, this is a major issue.
So that is one area that listeners might want to consider addressing if you reply to the public consultation. The value chain cap, Philip first. A big issue, as we know, is that not only in the Corporate Sustainability Reporting Directive was the scope raised, but that a semi-provision was brought in limiting how far companies could ask their suppliers for information. That's been further changed in this latest set of proposals. Could you explain and comment on that, Philip?
Absolutely, and it must be said that the EFRAG did not advise Commission on this, right? This is strictly in Commission's mandate. But the Omnibus Directive basically said that the Commission should adopt a voluntary standard, and that the content of this voluntary standard should set a cap on the information that large companies may require from their suppliers who have less than 1,000 employees. Now, I mean require. They can still request that information, but they cannot require it if that information is not in the value chain cap, for example, by contractual means. So anyways, the Commission was supposed to adopt this voluntary standard on the basis of earlier EFRAG recommendation for voluntary standard for SMEs that was designed for companies with less than 250 employees, now being applied as a value chain cap for 1,000 employees. So much for the theory. Now for the content. And that is that the Commission took that original standard, but it separated the data points in that standard in several categories and said only a narrow set of those data points fit in the value chain cap, and everything is above and cannot be required by large companies and from their suppliers. And this includes information such as on whether the supplier has a sustainability certification. And the way it is written, it means that companies wouldn't be able to ask their suppliers whether they have like EMAS or ISO 40001. They cannot ask or they cannot require information on GHG targets, on transition initiatives, on pollution, on water consumption in water stress areas, on whether the sites are in biodiversity sensitive areas, on the scope of their human rights policies, or on the actions taken by the supplier to address the human rights incidents that it has reported, right? So it's a very, very strict value chain cap, which goes much, much farther than what was actually in the original VSME standard. So this brings a huge question, at least to me, how this would affect companies and banks as well when they would try to understand or screen their supply chains for impacts and risks.
Simon, what this does is mean that there's even greater emphasis on estimates, and the Commission are very clear in their text. More estimates on the value chain, about the environment, about anticipated financial effects. Does this just reflect reality for companies, or is it potentially going too far?
If you look at our disclosures and maybe one step back, why do you do all of this? Is again to drive impact. Yeah, and if you look at, for example, our supply base, we've got thousands of bill of material suppliers, more than thousands, 5,000-6,000 or so. Do we have very active engagement with all of them? Of course not. It's not manageable. Yeah, is that needed? I also don't think it's needed. What you need to do is really apply, and the CSDDD also prescribes that, a risk-based approach. Are there, do you have got any leverage as a company over a supplier that supplies 20,000 euros of goods to you? I don't think so. Yeah. Do you have such leverage if the supplier is shipping more than 1 million or so to you? I think you start to have leverage. So what we do is that we basically have been focusing on driving impact in our value chain on those suppliers that meet specific risk criteria, meaning a definition of specific commodity types, a specific definition of risk countries or regions, as well as a spend threshold. If you do that, you come to a much shorter list. And that list for Philips is about 500 to 600 suppliers, where we really actively engage with and where we also ask very detailed information from. Normally, these are the ones also that exceed the threshold of the VSME or the voluntary standard, as it will be called in the future. If you do that, that whole discussion about thresholds and everything, we're not going to ask a supplier in Germany to react on human rights violations or child labor that are not applicable. We're not going to ask a caterer for specific chemicals information. But one of the key triggers of the whole simplification efforts by the Commission has been an over-asking by large corporates to smaller companies. And that was ridiculous anyhow. That to me, it indicates that companies do not know what they're doing, that they don't know where their impact is. And if you do, then this whole change, is not so much of an issue, and it definitely is not for us.
If I may react to that quickly, and I just wanted to say I fully agree with you. I mean, this needs to be based on risk and targeted, and what you've just described for Philips is exactly the way this is supposed to be done. But I believe there will be cases like, you might have a supplier in, not necessarily you, but a company might have a supplier in Europe, but in Spain, or in southern Italy, in a place where there's a water scarcity. And the value chain cap, as it is constructed, says that if that supplier has less than 1,000 employees, he wouldn't be able to ask them for their water consumption in that area. And that, I think the Commission has went too far now with where they put that value chain cap, and it may create problems in practice.
On the question of human rights violations, I take the point Simon has made. That's not for every single supplier, but one of the changes the Commission has made is to say it should only deal with quote substantiated cases. So that sounds like there has to be a legal process, and it needs to be quite a long way along the line of that before it even needs to be reported. Is that too restrictive?
It depends. Look, we put the word substantiated in our agreement in EFRAG So the Commission just reshuffled the text for mostly as part of the editorial changes. So actually, there's not a change in that regard, and you probably need to set some kind of a qualitative, boundary, just that companies would have some discretion to apply. But I do think Commission has overdone it, because it basically says that only the incidents that are substantiated should be included, including judicial proceedings. And the substantiated word or definition is specified as, the complaints or being supported by objective evidence. Now, if you have a judicial proceedings, right? I mean, it's the judge who decides whether evidence is objective, not a company, that is a defendant. So, there are these, small pieces, like small alterations of the definitions we have put in there, which really bring a question. I mean, is this really a simplification, or rather muddying the waters and creating a gray zone which can be abused? I don't think this will help anyone, but it may have undermine the transparency in specific cases where it matters most. And the same on the disclosure on biodiversity sensitive areas, for example, and a couple of other metrics scattered across the standards.
Yes, and there's a lot of human rights risks out there that never reach the courts.
What we also have to see is how all of this will interplay with legislation like the CSDDD, and so that will be the next test. So we will be all implementing now the simplified standards, either in 26 or 27, and then companies are on the hook for the next challenge, and that is the CSDDD in a simplified version again, and see if indeed all of this language in the legislation is really completely interoperable, or we will see some new challenges, and also time will tell in this case, I would say.
Final question to both of you, short one. Simon, the voluntary standard for SME, small business, the future voluntary standards they'll be called, was also brought out at the same time. We've not focused on that in this podcast, but there is a public consultation on that with the same deadline. Is there anything that you would say to our audience about what the Commission has put into that?
I would say to the audience, please, if you are in the category of companies where this is applicable to you, please have a careful look, because many of you have been complaining about large corporates, maybe Philips, maybe others, that have been over asking you, or force you to spend a lot of time on complying with one request from one company, and the next day you get the next one and everything. The golden nugget for this should be the voluntary standard. So please pay attention to this and see if this is doable for you, because if you do this well and you create this document, you may decide or may not decide to have an auditor even have a stamp of approval on this from a quality point of view, but you put that on your website and you should be done. So this is really, in terms of simplification, we all have our own responsibility as companies acting in society, I think, and some companies take this, a little bit wider than others. But this is the minimum threshold. But please pay attention to this, because it should simplify your life significantly.
And finally, Philip, just before that, again, EFRAG, Sustainability Reporting Board, brought out its work programme and foreshadowed what's going to be happening in the future. Just give us a flavour of the future direction of work in this field, EFRAG.
Absolutely, but let me just say that that what Simon said was just beautiful, and I think this is a message that everybody should pay attention to. But to your question about the EFRAG work plan, we have one standard setting task ahead of us this year, and that's to basically derive from the standards a standard for non-European groups, right? And that's quite an important thing. So that is in the pipeline, and then basically everything else that we have in the work plan concerns implementation support. Now those plans are still being crystallized. We need to agree how to do this in a way that's helpful to companies, that doesn't overwhelm them with too much implementation support guidances and questions and answers and so on and so forth. But there will be a lot of attention from the EFRAG to the practical problems that companies are facing, and trying to help to solve them in a, I would say, non-intrusive way, in a way that's helpful and that's not overly prescriptive.
In this podcast, we've heard how the European Commission has stuck to the concept of double materiality in the revised ESRS standards, that enabling companies flexibility in determining boundaries for emissions reporting may risk a loss in comparability, that the requirement for human rights risks to be substantiated before being included in the reporting risks being too restrictive, that recognition of the need to use estimates is realistic, but that information lost by way of the cap on requesting information from the company's value chain may also be over-restrictive. We've heard about concern about asset managers being exempted from the requirement to comply completely, and in those last answers we've heard about the significance of the new draft voluntary standards for SMEs, also issued by the European Commission and in the EFRAG Sustainability Reporting Board's Forward Work Programme. The consultation on the revised ESRS is on the European Commission website and it closes on the 3rd of June. Sadly, we have come to the end of our podcast for today. Thank you very much to Simon Braaksma and to Filip Gregor for joining us.
Thank you, Richard. And thanks, Philip.
Thank you both.
You've been listening to Frankly Speaking, the Frank Bold podcast on responsible business. Find out more about Frank Bold's Responsible Companies section on our website, and please give us your feedback on our LinkedIn page or by commenting via your podcast provider, where we hope you will share the conversation and give this podcast a 5-star rating. And remember, you can watch us on our YouTube channel too. Thank you again to Simon and to Philip and to all of you for listening. Do join us next time, and goodbye.